The sovereign debt crisis, once associated only with emerging markets and developing nations, has now become a potential future for the United States. Presently, the U.S. national debt stands at a staggering $33 trillion, with a debt-to-GDP ratio of 120%, the highest level since World War II. Despite these alarming figures, there is still a question of when exactly the United States' debt issues will become problematic. To answer this, let us delve into the numbers and examine the most important metric to consider. In personal finances, one would look at their net worth, which is the difference between assets and liabilities, as well as their income versus expenses. A positive net worth and positive cash flow indicate a healthy financial situation. Conversely, a negative net worth and negative cash flow, where expenses exceed income, are viewed as unsustainable. For the United States, the situation is similar, but with a significant advantage. It is the government. Being the government grants them a monopoly on violence, enabling them to collect any amount of taxes and borrow additional funds below market rates. Should these methods still prove insufficient, they can turn to the Federal Reserve to purchase their debt. These three avenues of taxing, borrowing, and printing money allow the U.S. government to continually increase their income to meet necessary expenses. The only limitation to this approach is the risk of hyperinflation, where the currency loses its value and people abandon it, resulting in economic turmoil. Recent examples of hyperinflation in countries like Argentina, Venezuela, Lebanon, Turkey, and Zimbabwe serve as cautionary tales. To avoid such a catastrophe, many desire to keep the U.S. government as far away from hyperinflation as possible. While some suggest that debt-to-GDP ratios at 90% or 130% are tipping points that lead to uncontrollable spirals, it is worth considering the impact of interest rates. If the interest rate on the debt is 0%, theoretically, the debt could be infinite relative to GDP without significant financial burden. However, this scenario may have long-term consequences. Therefore, it is more prudent to examine the cost of servicing the debt in relation to GDP. Presently, the annual interest payments on the national debt exceed $1 trillion. This estimation is based on the most recent payments, which were annualized. As of the third quarter of 2023, the actual interest payments reached $981 billion. In comparison, the GDP of the United States is currently at $27.6 trillion. Now let's crunch some numbers. If we divide the annualized interest payments, $1 trillion, by the GDP, $27.6 trillion, we can determine the burden of servicing the debt. This calculation allows us to gauge the sustainability of the United States fiscal situation. Currently, the U.S. government transfers approximately 3.6% of the national GDP, equivalent to $981 billion, towards paying the interest on the national debt. At first glance, this percentage may seem relatively low. To put it in historical perspective, we can refer to a chart from Bianco Research depicting interest expenses as a percentage of GDP since the 1940s. The green line on the bottom section of the chart illustrates that from 2004 to 2020, the interest expense as a percentage of GDP on the national debt reached historically low levels. Conversely, during the period from 1980 to 2000, the annual interest expense as a percentage of GDP hit record highs. Thus, a value close to 3% represents the norm for the past century, while anything surpassing 4% is considered abnormally high. Notably, the chart reveals that the interest expense has never surpassed 5%. However, the most alarming observation from the chart is the sharp, upward trajectory seen in recent years. The vertical hockey stick-like curve at the end signifies that if this trend continues, it won't be long before the U.S. government is compelled to allocate over 5% of the GDP solely to maintain the mounting debt. Importantly, this percentage pertains to the nation's total economic output. With the current trajectory of increasing interest costs on the national debt, the situation appears to be heading into onerous territory in the near future. But can we predict precisely when this threshold will be crossed? Let's turn to our crystal ball, or in reality, our trusty calculator. To make an accurate projection, we need to consider two variables: the interest cost on the debt and GDP. While both can change, estimating the interest cost on the national debt proves more manageable as it is somewhat predictable, primarily dependent on prevailing interest rates and the debt burden. Let's start with that. As of the third quarter of 2023, the interest payments on the national debt amounted to $981 billion. However, based on more recent data, the annualized figure now exceeds $1 trillion. To refine this estimate, we can refer to a chart from ingoldwetrust.com presenting the breakdown of each country's debt maturity as of January 2023. To grasp the gravity of the situation, let's examine the interest rates the government pays on its 10-year Treasury bonds, which are indicative of government borrowing costs. The last time interest rates were as high as they are today was in 2007. This means that the U.S. government borrowed money at lower rates between 2008 and now compared to current rates. In 2008, the national debt stood at a mere $14 trillion. In less than 2 decades, this figure has more than doubled to $33 trillion. Remarkably, this increase occurred during a period when interest rates were lower than they are currently. As a result, a substantial percentage of the national debt must be refinanced, requiring the United States government to borrow new money at higher interest rates to repay old debt that previously incurred lower rates. Currently, the interest expense accounts for approximately 3.5% of the GDP. However, by the end of 2024, the total interest payments are anticipated to reach closer to $1.2 trillion. To arrive at this projection, we consider the total debt that is due to mature by the end of 2024 and calculate the interest payments based on prevailing interest rates. Consequently, the interest costs will increase from $981 billion to approximately $1.2 trillion. During the course of 2023, roughly 1/4 of the U.S. debt was refinanced at an average interest rate of 5%. Although some shorter-term maturities likely exceed 5%, for simplicity, we will assume a conservative rate of 5%. Consequently, we can estimate that $412 billion was rolled over during 2023, assuming interest rates remain stable. Assuming the federal government continues to rely on short-term debt, we can project that another quarter of the national debt, which matures during 2024, will also be refinanced at an average rate of slightly over 5%. By multiplying the total rolled over debt amount during 2023, $412 billion, by 2, the projected interest cost on half of the national debt comes to $825 billion. The remaining half of the national debt, which has yet to mature, will still benefit from lower interest rates. To calculate the interest cost on this portion, we divide the current interest payments from the previous quarter, $981 billion, by the total national debt of $33 trillion, resulting in an average interest rate of approximately 3%. Multiplying the remaining portion of the national debt, $16 trillion, by an interest rate of 3% indicates an interest cost of $480 billion. When combining the interest costs of $825 billion for the portion that will mature by the end of 2024, with the estimated $480 billion for the remaining portion of the national debt, we arrive at a total interest cost of $1.3 trillion by the end of 2024. In simple terms, if the math seems overwhelming, think of it as analyzing all the government's credit cards and determining the impact when introductory rates of 0% and 3% expire. Now let's delve deeper into the potential GDP growth. Personally, I anticipate a decline in GDP during 2024. Nevertheless, for the sake of analysis, let's assume it does not occur. In the third quarter of 2023, the U.S. GDP unexpectedly increased by an annual pace of 8.5%, amounting to $560 billion. This growth brought the current GDP to $27.62 trillion. Consequently, let's assume that the United States sustains the same remarkable pace of $560.5 billion growth every quarter until the end of 2024. When we multiply this amount by 4 more quarters, we reach a GDP growth of $2.2 trillion. Adding this figure to the current GDP of $27.6 trillion, we have a total GDP projection of $29.8 trillion. Now, we can begin to merge these two elements. Taking into account the expected increase in interest costs, which is predicted to reach $1.2 trillion or more by the end of 2024, we realize that this figure cannot decrease significantly due to the maturation of the debt, which necessitates rollover. Unless interest rates significantly decrease, we can expect the government to spend at least $1.2 trillion solely on interest costs by the end of 2024. If the GDP continues to grow at the same blistering pace observed in the third quarter, then it will reach $29.8 trillion. To determine the significance of this interest payment, we need to calculate what percentage it represents in relation to the future GDP projection. By dividing $1.2 trillion by $29.8 trillion, we find that it corresponds to 4% of the projected GDP. Consulting our chart, interest expenses as a percentage of GDP, we discover that 4% lies just outside of one standard deviation. Historically, when interest expenses exceed one standard deviation, it becomes abnormally high and places a burden on the economy. However, it is essential to consider alternative scenarios. What if GDP does not grow in the upcoming year? Even if we do not encounter contractions or enter a recession, let us assume that the tremendous growth witnessed in the third quarter ceases. The current GDP stands at $27.62 trillion. Dividing the future interest cost of $1.2 trillion by the current GDP yields 4.3%, which is significantly closer to historical record highs. As an additional point of interest, let's examine what it would take for the interest expense on the national debt to surpass 5% of the GDP, thus reaching a record level. If we divide the interest expense of $1.2 trillion by 5%, through the lens of the current GDP of $27.62 trillion, we arrive at $1.38 trillion. Subtracting the expected $1.2 trillion by the end of 2024, we are left with a difference of $181 billion in interest expenses. If we divide the current average interest rate on government debt, 5%, by $3.6 trillion, which represents the increase in the deficit, we can see that during 2020, our nation had a record deficit of $3.1 trillion. We did manage to recover in 2022 to a mere $1.3 trillion deficit. But as of 2023, we are unfortunately heading in the wrong direction again. Despite this, it does not seem that the interest on the national debt will pose a significant issue in the short term. It is not expected to have severe impacts within the next 12 months through the year 2024. However, it is likely that these increased deficits will push interest rates, particularly short-term interest rates, higher. This is because as the government rolls over its debt, it will have to borrow short-term debt to pay off the old debt. This additional supply of debt and borrowing creates a demand for lending on the opposite side. When this demand is lacking, interest rates rise until the demand returns. Therefore, throughout 2024, we are very likely to witness higher interest rates as a result of the government's increased borrowing. However, it is crucial to note that a sovereign debt crisis, collapse, hyperinflation, and government defaults are not things we should expect during 2024. These are long-term issues that take time to unfold, even at the current pace of increasing interest costs. It will likely take closer to 2 years before interest payments reach a record as a percentage of GDP. Even then, it merely becomes a larger burden on the economy, which in turn pushes it closer to, or deeper into, recession. This is not to say that things cannot spiral quickly, but as it stands, it does not appear that this will occur within the next year or two. These situations often take longer to develop than most people anticipate, especially those who are vigilant and foresee the impending challenges. Now let's look at 2 action steps that everyone should be considering based on the current circumstances. First, instead of viewing higher interest rates as a negative, people should be exploring ways to take advantage of them. Instead of using debt to buy things, which incurs increased costs, one should only use debt to buy assets. Moreover, it is essential to consider fixed debt with a long maturity, ensuring that the assets purchased generate more revenue than the debt incurred. Individuals should consider reallocating a portion of their investments from equities, as the stock market is currently at record highs, to assets like T-bills or money market funds, taking advantage of higher interest rates. The second way individuals should aim to benefit from the current environment is by taking advantage of the declines in equity and asset prices. It is essential to think beyond the binary options of buying or selling and staying in cash. Sophisticated investors understand the potential to profit from downside opportunities. While it is possible to make money in bullish markets, the true fortunes are made in bearish markets. Learning to navigate both situations is crucial. If you require assistance in managing debt, cash, high interest rates, hedging equity positions, or capitalizing on market downturns, I teach hundreds of active investors every month to do exactly that through Heresy Financial University. A monthly membership of $99 grants unlimited access to training materials that cover all the discussed strategies. We also offer monthly live streams where members can ask questions and receive guidance. The current price of $99 per month will be locked in for existing members. However, starting January 2024, the price will increase. To secure the $99 monthly rate, sign up now before the price adjustment takes effect in 1 month. The link to sign up is in the description below. Thank you for watching, and have a fantastic day.